Hi guys, so today I'm going to do a tutorial regarding how you can trade the markets utilizing monetary policies. So we are all aware of what's going on right now in the world in terms of central banks hiking their rates and trying to slow down inflation. So we're going to speak uh, in summary uh, of what we really need to understand in regards to what's going on around in the moment from a macro perspective and how that impacts uh, our trades or how it impacts the, the forex trading. So the macro perspective, we all know the macro perspective when we are doing our analysis, it starts with the interest rates, right? Everything that you do if you are trading mainly currencies, right? The macro perspective has to begin with the central bank interest rates. These rates are set to stimulate or instigate inflation in a country's economy, which is the point where we are at this moment in time in regards to high inflation, central banks trying to reduce inflation by raising interest rates. So the long-term macro concept is to look for high interest rate country, and then you pair that country with a low rate country. What that means is the respective currencies, when they are matched together now as a forex pair that you can trade, we can clearly define it as fundamentally poised to strengthen in relative terms against others. So basically, we're talking about a country that has got higher rates versus a country that has got lower interest rates. For instance, we can pick, say, Euro JPY. Euro has got 0.5 interest rate, and then we've got the yen sitting at negative 0.1%. So, in other words, we are actually looking for euro to gain against the yen, and vice versa is also true now, whereby if you are looking for a low interest rate country paired with a high interest rate country, these pairs would be viewed as fundamentally poised for weakness in relative terms against all others. Now, remember, it's not like that is the case always, right? But fundamentally speaking, a country that has got higher rates versus a country that has got low rates, the country that has got higher rates should see strength, right? Vice versa, a country that has got lower rates versus a country that has got higher rates should see weakness in the country that has got lower rates. So, for example, we can see a low rate country versus higher rate country. So, we're looking at which one has got lower rates here. Low rate country, we've got euros at 0.5, we've got CHF at negative 0.75, then we've got the yen at negative 0.1. Then on higher rate side, we've got the Canadian dollar, we've got the New Zealand dollar, we also have the Australian dollar, we've got the Federal Reserve. So we can probably look at a low rate country like ECB, Euro, versus a country like Australia, the Australian dollar. So that is 0.5 versus 1.35%. So fundamentally speaking, we would be bearish on that pair. Now, as we look to what's happening at the moment in the markets, like what's currently driving the markets, inflation and interest rates. You see, not many central banks had forecasted what Russia and Ukraine are going on about. You see, so with COVID coming, most central banks they pumped in a lot of money. there was too much free money in the economy. Now, too much money is also not good, right? That means people are going to spend a lot, spending a lot, a rise in inflation. Yes, there's energy crisis. Oil prices went to record highs and all that. So from a monetary policy point of view, right, which is, we've already covered this, guys, in I think it's week 3 or week 4. We've already covered monetary policies and how it influences or affects the financial markets, particularly on a higher time frame directional bias, right? One of the main difference between retail and institutional traders is the degree of competence in fundamental driving forces behind market moves, right? Many retail traders do not understand or simply choose to ignore how the current political and economic climate can determine the overall directional bias of the market. And most retailers, they fail to explain why one currency strengthens against its peers over a period of time, and also vice versa. You see, it's something which, if you gather around your friends who are traders, retail traders, we are all retail traders. You find out that most of them, they really do not understand the fundamental aspect of what drives the market. Most of them, they're just going to jump onto a chart. They open their charts, moving averages, indicators, and a whole bunch of stuff to determine where price is likely to go. But that's not what we are about here in this mentorship, guys. And I'm sure by now you should understand this, right? So therefore, in understanding of macroeconomics and fundamentals can provide traders with an edge in the marketplace. The very nature of trading, that is the edge. Once you know and understand the macroeconomics and fundamentals, how they move the markets. So I believe this form of understanding is essential for high probability effective trading, as it allows a trader to trade with momentum and develop an understanding of how and why institutions are positioning themselves in regards to one currency or another, right? So, which brings us to the question, right? What is monetary policy, right? Monetary policy is the protocol taken by central banks, right, to influence the circulation of money in a country's economy, right, and the cost of that money, right? So you know what this makes money? That makes money a commodity. You see, not many people understand that part. Money is a commodity influenced by supply and demand. Pick out any commodity out there. What does it have in terms of value? It has got a price, right? So far in 2022, controlling the rapidly increasing levels of inflation has become the main priority. Number one important thing that central banks around the world are looking to what? To reduce. Every central bank is fighting inflation, right? So, as with other commodities such as oil, gas, platinum, silver, and all that, money has a cost in the form of interest rates. You see where the thing starts to make sense now, right? So, basically, money is a commodity. Yes, we use it to buy other stuff, but from a monetary point of view, it is a commodity that has got its own price, and that price is embedded through interest rates, right? So a rise in interest rates, in theory, reduces the spending in the economy as the price of money increases. I hope you understand that part. A rise in interest rates, in theory, reduces the spending in the economy as the price of money increases, right? So this leads to a reduction in economic growth as GDP is squeezed, and therefore the demand for goods and services is reduced, meaning suppliers look to decrease their prices to entice demand, which in turn now reduces inflation, right? So this is the main thing that you need to understand as a trader, and how that impacts your day-to-day trading, how it impacts you coming up to a decision to say, okay, I'm gonna be bearish on this pay here for the next 2, 3, 4 weeks, or even a month, right? So with the record high inflation rates that have been a consequence of the influx of free money flowing COVID-19 pandemic and low interest rates, we all know that when COVID strikes, uh, almost the majority of central banks had low interest rates. Why? Because inflation was very low, so there was no need to have high interest rate, right? So excessive quantitative easing through asset purchase programs and follow schemes were used throughout 2020 and 2021. So these are something like what we have here in South Africa, our 350 Rand grant, whereby people would get free money at the end of every month during the COVID. And I'm sure by now people are still getting that COVID relief, right? So this was just done to hold the global economy as the world was under shutdown. So this cheap money has led to increased spending, thereby creating a high velocity of money where money is exchanged between people frequently for soaring price increases. Supporting their respective economies throughout the pandemic was a priority for central banks. You see, it was a priority. They couldn't just sit about and see the economies crashing. But now that the tune has shifted now from expansionary monetary policy to a contractionary monetary policy, they need to now to redo what they did during 2020 and 2021, right? So one of the main contributing factors to rising inflation has been the current Russia-Ukraine war, right? The tightening of global supply chain. Don't underestimate this conflict between Russia and Ukraine, because it's going to be with us for quite some time, right? So the conflict has been followed by swift sanctions and an embargo against Russian exports, which for me, I think the powers that be did not really think properly regarding these embargoes that they put over Russia. So, as the largest natural resource producer in the world, which is Russia, this decision has held a heavy weight on gas and oil, thereby bringing about the energy crisis that we are having at this moment in time. So, energy prices have a major bearing on inflation, which at the time of this recording here in the US and UK is currently sitting at 9.1%. That's huge. That is humongous. That is very high for these two world economies, right? So how does it impact the markets, right? So the consensus on the direction of monetary policy is that the major central banks will be raising interest rates to tackle what? These issues, right? The situation between Russia and Ukraine is unlikely to go anywhere, guys, for the foreseeable future. We all know that. So inflation is expected to continue as supply chains try to adapt now to the current situations. As the market reacts to upcoming announcements, we've got the Fed tomorrow. Both retail and institutional traders can reasonably expect high volatile conditions for the foreseeable future based on interest rates and inflation, right? So central banks have a job on their hands to balance interest rates to subdue inflation, but do not want to risk now increasing rates too quick, right? Too fast and too quickly. That may cause a recession. They might not need to accept it, but I think economies like most economies are already in a recession, right? And this is going to result in very high levels of unemployment. At the time of recording, a big online e-commerce company, Shopify, has already announced that they are laying off almost 10% of their workforce, right? So yeah, that it's going to have huge implications in the near future. So some economies can handle faster increase in interest rates than others, and this will impact their currency strength versus other currencies. Take note of that statement there. So then how do we utilize this in our day-to-day trading? So every trader cannot know exactly what is going to happen next. Like last week, we had ECB smash bang, they go 50 basis points increase from 0 to 50. Not many people had forecasted that. Everyone was anticipating a 25 basis points. So it is our job to constantly develop our understanding and allow our edge to play out over time. If we are combining our technical analysis tools, which we teach in the mentorship, with fundamental driving forces, we are trading behind the momentum of high probability conditions. Now, remember that large financial firms and multinational banks make up a large majority of daily volume in the FX market. These institutions move large amounts of currencies based upon market releases, such as rising interest rates. Therefore, trading with a trend alongside these institutions can be an effective way to trade low risk, high reward setups. So we want to avoid trading purely technicals or just fundamentals, right? Our objective is to incorporate both technical and fundamental analysis in understanding for additional confirmations behind our ideas. So this is because we can get caught into the fear of missing out moves, right? You see a pair moving massively to the downside and say, oh, let me jump in. Redistribution is going to kill you. Or you see a pair rallying to the upside. You try to jump in. Reaccumulation will kill your account. So when the market may have already priced in the news, so the announcement may see the price move in a different direction than what is initially expected in your analysis. However, when the two line up in a confluence, it can make for some explosive moves. So yeah, to conclude, the current market conditions and overall sentiment is creating turbulent price moves in the market. Fears over rising inflation have forced major central banks to tackle the issues through rising interest, raising interest rates, right? So current monetary policies around the world are indicating a willingness by policymakers for rapid restructuring of the world. This could lead to a global recession as supply chains tighten, company revenues drop, and unemployment rising to record levels. So for now, we must continue to develop our understanding using lessons like this to protect ourselves from upcoming events, while it's also taking advantage of the trading opportunities that come up. So yeah, this is what I wanted to share with you guys so that you get at least an understanding of how interest rates and inflation go hand in hand. So particularly, make sure you understand why do central banks raise their rates, right? This is for them to fight inflation. So you might need to look at countries that have got higher inflation and focus on their central banks to increase the rates. Once inflation starts coming down, we will see that most of these central banks that have been on a massive scale of increasing their rates, they might start to uh, cool down a bit, but we're not going to see uh, that anytime soon. So you can already see that New Zealand, Australia, they are well above almost 2% now on their interest rates. They are really uh, attacking inflation at a very rapid pace. So these are some of the countries that can at least sustain or increasing the rates quite quickly. So yeah, that's pretty much for today, folks. Unfortunately, I couldn't record yesterday due to some foreseeable reasons, because I had promised you guys that this video will be online yesterday. But yeah, be that as it may, you now have something to watch and take some notes. So with that, I wish you guys good luck and happy trading. Thank you.